Should you invest in hybrid funds now? With some recent tax amendments, which got done in April 23, debt mutual funds had a significant change in the way that taxation happened, bringing them on par with fixed deposits. Whilst a lot of people believe that as a result of this tax change, debt funds are not attractive anymore, there continues to be a strong case for debt mutual funds in certain scenarios. For example, if you do not require any sort of interest, in a bank deposit you need to pay tax even if you don't take the interest out. Whereas in the case of a capital gain which you make from a debt mutual fund, there is no such challenge. In addition, if there are any losses that you have in other places in the form of capital gain, you can adjust those against gains that you make on debt mutual funds. Let's try to spend a little bit of time in terms of what exactly this tax change was about and why we think that there might be a case for hybrid mutual funds as a result of this tax change. Prior to the tax change, what would happen is, if you bought a debt mutual fund and held it for more than 3 years, you got the benefit of indexation with a 20% tax rate, which meant that your effective tax rate was probably anywhere between 10 to 15%. This is what was called long-term capital gain on non-equity instruments. Post the change, this definition of time frame linked to debt mutual funds was removed, and therefore there is no more any definition of long-term or short-term as far as a debt mutual fund is concerned. As a result of which, irrespective of when you sell, you pay tax as per your marginal tax rate or your tax slab. This change has come about for everything where equity is up to 35% in the portfolio, which effectively has meant that the impact of this is being felt even on certain hybrid kind of funds. For example, there are conservative hybrid funds which have less than 35% exposure to equity, and therefore those have also now become more tax inefficient as compared to what they were prior to April 1, 2023. However, a lot of funds which have presence in the hybrid space with more than 35% equity exposure now become alternatives. For the 35% to 65% equity space, as of today, there are very few funds, and therefore you should expect a whole lot of funds to come into that category through new fund offers, some of which have already started. However, in the category where there is more than 65% equity exposure or exposure to equity-like instruments, you have at least 3 categories which you can consider. Number one, what are called balanced advantage funds. These are funds that move between debt and equity through a mathematical model which is typically designed by the mutual fund house. The way this could be done is through either measures like price to earnings or price to book, or there could be other ingrown models which could be used to move this allocation depending on the fund manager's view as well. The advantage that these have is that whatever changes happen within the portfolio are not taxed in your hands because you are continuing to hold the fund. So for example, if equity markets fall and the proprietary model increases equity exposure, as an investor, you are perfectly okay because the fund goes out and increases equity exposure. Vice versa, if the reverse happens, equities become expensive, people want to sell equities. If they sell it themselves, they'll pay tax, but if the fund sells it and reduces equity exposure, there's no tax liability on you as an investor. If you buy this kind of a fund and hold it for more than 1 year, you'll be taxed at only 10%. And the fund manager has the ability to go anywhere between 30% to 80% in equity. So it's a fairly interesting category for investors to look at. The next category that can be considered are what are called aggressive hybrid funds, where the equity exposure is much higher. It ranges between 65 to 80%, and bonds make up the balance 20 to 35%. Again, because the equity exposure is above 65%, you get the equity tax treatment, long-term 10%, for more than a year, short-term 15% for less than a year. Lastly, you can also consider what are called equity savings funds. These are having equity exposure which is much lower, normally about 30 odd percent, but they use a lot of arbitrage or derivative instruments to essentially create a 65% equity plus exposure effectively, as a result of which they end up getting equity taxation. And therefore those could also be options for investors who want to be more conservative in their approach. All in all, as a result of this change, there could be a meaningful shift in your investment strategy, provided you're clear that number one, this sort of asset allocation is only being done at a fund level. At a portfolio level, you still need to do it yourself. Number two, remember that whenever these kind of events happen, it's very tempting to use only tax as the basis to make this decision. That should not be the case, because if you have short-term goals, debt continues to be a very, very attractive option. And last but not the least, keep in mind that tax laws can also evolve over a period of time, and therefore the investment strategy for today may not be the investment strategy for tomorrow. Investments in securities are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BISL, and certification from National Institute of Securities Markets, NISM, in no way guarantees performance of the intermediary or provides any assurance of return to investors. The information is only for the consumption by the client, and such material shall not be redistributed. The securities quoted are for illustration only and are not recommendatory.